On overnights,
I believe in reason and common sense.
Leith Van Onselen from Macro Business with the Treasury of Common Sense.
Common sense never goes out of style.
Good morning, Leith. I trust you're well.
Yeah, good, thanks, Mike. How about yourself?
I'm fine, thank you. Mr. Van Onselen is Chief Economist of the MB Fund and MB Super and co-founder of Macro Business. And this is a regular feature where we talk about the Treasury of Common Sense, always hoping that there will be some to be found, Leith.
Yeah, that's right, mate. Common sense is not so common, unfortunately.
No, indeedy. The national accounts release from the ABS, a bit of spin from Smile and Jim, of course, but how do you see it?
So the Australian Bureau of Statistics released the December quarter national accounts. So that's basically where you get your GDP figures and all that sort of stuff. It's like the key backward-looking indicator on the Australian economy. I say backward-looking because it's only up to 31st of December, so we're already, nearly a quarter past that.
Indeed.
But nonetheless, it came in very soft. So basically, the Australian economy grew by 0.2% over the quarter, and that was below the, slightly below the economists' expectations and slightly below the Reserve Bank's expectations, but the big thing about it, Mike, was that the detail, so when you actually, look at what drove the growth and what didn't grow, et cetera, was really poor. So basically, what delivered Australia growth over that quarter was we had a big rise in net exports. So that's basically our trade. So it wasn't because exports necessarily went up, it's because we imported less, because there was less demand in the economy. And that's basically what delivered our growth. Now, the thing that matters for us is obviously per capita terms. Yes. So once you strip out population growth, the economy fell by, so per person, the economy went backwards by 0.3%, and it was also 1% lower in 2023, so over the whole year. So it was another case of this, the economic pie has grown, but everyone's slice of the pie has shrunk. And the reason for that is obviously we're running a huge immigration program at the moment, so that's sort of keeping the economy growing, albeit very slowly, but everyone's slice of the pie shrunk. And the worst aspect of this release, Mike, was that we're all households. So anyone listening to this is a household, right? So that's what we care about. We care about how are Australian households travelling, as opposed to businesses, as opposed to exporters, the government, all this other stuff that feeds into the economy. Households drive nearly 60% of the economy. So, and that's what we care about because we're households. We live in that world. And real per capita, so once you strip out for population growth and inflation, household consumption actually plunged by 2.5% last year. So that's absolutely insipid. So basically we all went backwards a lot quicker than the economy did in per capita terms. So the household sector's been smashed. And it's pretty obvious why. We've obviously had really, really poor income growth. So incomes went backwards over the year, obviously higher mortgage rates. The average taxes paid, so the amount of tax we paid went up, and all these sorts of things we talk about every week. And the key takeaway, though, is that although the economy, was a little tiny bit softer overall than what the Reserve Bank was expecting, the Reserve Bank had penciled in much, much stronger consumer spending, which is probably, arguably its key input for interest rates and things like that. So just to put that into perspective, the overall household spending, so that's including population growth, only went up by 0.1% over the quarter, so 0.1%. In November last year, the Reserve Bank forecast that it would have gone up by 1.1%. And in February last month, the Reserve Bank revised that down to 0.4%. So even with that downward revision in February, consumer spending was a lot weaker than what the Reserve Bank expected. And that to me sort of tells us that that the RBA will probably be a bit surprised by that, and they'll probably go, geez, the economy's, the household sector, which is the main thing we look at, it's a lot weaker than we expected. Pretty much all the economic indicators that have come out the last few months have been weaker than what the RBA expected. So we had lower inflation than they had forecast. Retail sales have fallen a lot quicker than they expected. The unemployment rate's risen faster than they expected, and then now we've obviously had worse overall growth, slightly worse overall growth, but much worse household consumption growth than what the Reserve Bank expected. So this sort of, to circle it all back, is just yet another indicator which kind of supports that view that
Indeed.
Interest rate cuts are going to come, sooner rather than later.
I was counting up the number of times in the last few seconds that you said the Reserve Bank expected, followed by that didn't happen. Wasn't it John Kenneth Galbraith who said forward estimates are only there to make astrology look respectable?
Yeah, look in their defence, it's, the economy is always very hard to predict. There's just so many moving parts, and there's always, but at the same time, they are notoriously bad at certain things. So, for example, they're always, expecting wage growth to rocket. And they've been, for about the last 10 years, have said, we're going to have a big uptick in wages, and it never comes.
No rocketing.
No, that's right. In fact, basically wage growth always seems to disappoint their expectations. There are a few things where they, tend to be notoriously wrong. But, again, the biggest factor here, which is working against them and which augurs well for rate cuts, is their unemployment projections. So their latest statement of monetary policy last month predicted that by end of December this year, end of the year, the unemployment rate will be 4.3%. Well, it's already 4.1% in January. So it's only 0.2 below where they thought it'd be at the end of the year, and it's deteriorating a lot quicker than what they expected. And based on this data that we got and the retail sales and everything else, consumption spending is falling a lot quicker, and that's going to drive up unemployment, because that's the key sort of growth driver within the economy. And it just means interest rate cuts are going to come, more than likely in the second half.
Of course, the problem these days is trying to find anything at all. There are a number of factors contributing to that, but I was kind of struck by a sentence from you here. You say the problem is housing construction is plummeting at the same time as the population is growing, like a science experiment. It does seem to be like they're kind of detached, they're not involved. They don't seem to be even that concerned about it.
So since the last time I spoke to you, this time last week, we've had a few more disastrous indicators for the housing market, which just tells you that the situation is getting worse. So the shortage is getting worse. So first of all, the Australian Bureau of Statistics late last week reported that, started this week, reported that dwelling approvals have fallen further. So basically, Australia only built about 170,000 homes in last year, and once you account for demolition, so basically they built that many homes, we also lost a whole bunch of homes because they do knockdowns and rebound builds and stuff. We only added about 163,000 to the housing stock. Now that was against a population increase of 626,000 last financial year. So we're not building nearly enough homes, and the ABS reported that dwelling improvements fell in January, and they actually fell to their lowest level since May 2012.
Yes.
In trend terms, which is basically when you get rid of the month-to-month volatility.
Right.
And so only 163,000 homes were approved for construction in the year to January. So that is 77,000 less than what the Albanese government's housing target is. So you might remember they said they're going to build 1.2 million homes over 5 years.
Yes.
So that's 240,000 homes a year. And so based on this approvals data, they're 77,000 behind that. To be quite honest, all indicators for housing construction, talking about approvals, commencements, completions, new home sales, loans for construction, they're all tracking around decade lows. So they're all going the wrong way at the same time as we're importing, near record or near record numbers of people to, obviously create these pressures. Now, Domain, which is a, key, one of the main private sector data providers for housing, reported this week that Australia's rental vacancy rate nationally fell to 0.7% in February, which is the lowest on record. Yes. And it's around that level across all the 5 major capital cities.
Apart from anything else, of course, we're looking at all these builders going broke.
There's 3 main reasons why we can't build enough houses, and we're not going to get anywhere near close to what the Albanese government's housing target is. First of all, we've got much higher interest rates than we had 5 years ago, say. Secondly, materials costs surged over the pandemic. So that's talking about plasterboards, bricks, everything. Anything that goes into building a house, steel, all that sort of thing, is up significantly since the pandemic. Yes, the inflation has fallen a lot, but we've still got that embedded cost that we had over the last 3 years. And that's basically meant that builders can't turn a profit, and we've got them going broke left, right and centre. And to add further insult to injury, we've got severe labour shortages because the home building industry is now competing for workers against all these large infrastructure projects that the state governments are doing purely to keep up with population growth. So that just means that if you're a tradie right now, you're going, gee, am I going to build houses, super risky environment where, the builder might go broke and not be able to pay me. And it's just, it's very risky at the moment, given the situation we've got. Or am I going to go and work for a state government, for example, or one of these ginormous construction firms who have got a contract with the state government to go and build tunnels and all the other commercial properties and all the other stuff that state governments are doing? You're going to obviously pick that choice because it's safer, you get paid more, it's just a more low risk option. So what that means is that we can't build these houses.
Indeed. Yeah.
At the same time, the government's just fire hosing in record numbers of people, and that's what's driving the rental vacancy rate through the floor. It's creating an extreme housing shortage. It's going to get worse. It's pushing up rents. It's forcing people to live in group housing, and it's forcing people to become homeless. And the question everybody should be asking the Albanese government is, why have they brought record numbers of people into Australia, and why do they continue to do so without a plan to actually house them and provide them with infrastructure? Because the whole approach is basically, we'll just do it and, damn the consequences. And Blind Freddie could have seen that this was going to happen.
I know.
When you run it, when you're bringing over 500,000 people in a year, you're going to create these indigestion left, right and centre with housing infrastructure and all this sort of stuff. And basically, because of Labor's incompetence, Australian tenants have been forced to pay high rents, they've been forced to live in group housing, they've been forced into homelessness. It's an absolute inequality disaster in the making, and it is brought to you by the federal government.
Indeed, it really is that straightforward. Leith, appreciate your time and comments as always. Thank you for that.
Yeah, thanks, Mike. Speak to you next time.
Okay, we'll talk then. That's Leith Van Onselen, and Leith is Chief Economist of the MB Fund and MB Super co-founder of Macro Business.